Welcome everyone. Today we will discuss the aggregate demand and multiplier model. Now, briefly, I'll introduce the outline. In this video, I will have the introduction and measuring the aggregate economy covered. Then we will talk about interpreting the gross domestic product, the GDP, and we will introduce the multiplier model, and we will end this section, this unit, with consumption and investment in the last video. Now, the introduction. As you can see, the aggregate behavior of the economy has something important to say about the ordinary people's daily experiences. So we see post-2007 recession, people asked if they have lost their jobs, and a considerable portion said yes. They're asked if they start a new job that they did not like. Again, a considerable portion said yes. Taking a job below education and experience, so not matching well, if you will, yes. Taking an additional job, again, and yes there. And you can see quite a few unpleasant experiences, all connected to the financial crisis. So there's something to be said about the overall performance of the macroeconomy and ordinary people's experiences. So this is something that we want to discuss: why recessions happen, how business cycles take place, and how a picture like this could be avoided ultimately. So in this unit, we will introduce the concepts of national accounts and gross domestic product. We will discuss the causes and consequences of the business cycle, and we will use the multiplier model to study the business cycle. Now let's start with measuring the aggregate economy. How much does the economy produce? This is not something easy to calculate or solve, particularly because if you were to consider the variety of goods and services that are produced, it isn't very easy how to just add these values up. So estimates we use, these estimates of a country's total aggregate output date back to at least to the work of the 17th century English medical doctor and professor of music, William Petty. So nowadays, the calculations are the specialized task of a huge group of statisticians following internationally agreed guidelines for compilation of national accounts. Notice the idea here is these statisticians tend to collect data from the businesses and try to make estimates, of the overall economic activity. And we try to have an internationally agreed guideline for this so that we are able to compare different nations' economic performances. The measure of aggregate output that is used is called gross domestic product, GDP. And in this section, we explain why this is also a measure of aggregate expenditure and of the total incomes of the country's residents. There are three ways of constructing GDP from economic data, corresponding to measurements taken at three different points in the circular flow of the macroeconomic life: output, incomes, and spending. So these are equivalent measures of the overall economic activity in an economy. So we're speaking of this circular flow model. What's the idea here? Notice people earn some incomes. They use that for spending money, right? So they have this expenditure done. Well, this expenditure keeps the businesses on float, and with the earnings they got, they are able to produce more, and they produce, they sell. As a result, they pay people incomes, right? So somehow this circle should generate equivalent income, expenditure, and output values as it moves on, right? So the sum of outputs of the different sectors of the economy, this is production, is measured by the value added in this case. So if we are looking at the value added approach, you will see a certain amount. This value added idea pretty much is indicating that the inputs are turning into outputs. So in that process, the value of the goods are increasing, and we are looking individual establishments, how much value they are adding in the process. And these inputs will be measured in the value added of other industries as well, which prevents double counting when measuring production in the economy as a whole. And the sum of incomes paid to the various factors of production, such as labor and capital, is going to be reflected here. This comprises the wages, profits, and the self-employed income, and taxes received by the government. And lastly, the sum of expenditures on total production in the home economy, so the domestic economy by its final users, which are households, firms, the government, and the residents of the other countries. So these three measures are supposed to give us the same value, so that we're able to say the value-added approach, income, and expenditure approach all give us the same total value. And if you again try to look into the relationship between the households and firms, always keep in mind firms provide goods and services to households. Households give back money in the form of expenditure. So for goods and services, they spend money to firms. Households also supply labor and capital to firms, right? So whatever capital they have, they may lend. Whatever labor they have, they may lend. And firms, as a response to this, they generate, first of all, value added with the use of labor and capital of households, and they generate income out of that. So income received as wages and profits from the production of goods and services are given back to the households. Ultimately, some households earn the profits, some earn the wages, some earn the self-employment income. These are all income generated by the firms, distributed to the households depending on how they locate in the economy. Now, let's start with the value-added approach. This is going to be the production approach to identifying the total income in an economy. And the economy in this example is going to be producing a single good, a cotton shirt. And the shirt industry buys cloth for $80 from the cloth industry, which in turn buys cotton from the raw cotton industry for $50. So finally, the shirt is sold for $100. So the cotton shirt is $100. The raw cotton was $50, and that's turned into cloth, and that was $80, right? So measuring the GDP according to expenditure approach shows that the final product or GDP of this economy should be equal to $100. So what we bought at the end was the single good, the cotton shirt, and if the price of that is $100, the gross domestic product also needs to be $100. And GDP can be measured by the value added by each industry. And in that case, the textbook here is assuming that the raw cotton industry is not using any inputs. It's pretty much collecting that from nature and selling it for a price, right? So if you are in some way self-employed, you could also say you're paying yourself this as a salary, so you don't have costs in that way. Your price of output is $50, that's it. And in that case, from no costs to a price of $50, you have added $50 of value in this process, right? So 50 minus 0, you have 50 here. Now, this raw cotton is bought by the cloth industry. So the cloth industry has an input of $50, and that's sold after turning into cloth for $80. So notice 80 minus 50, the cloth industry has a $30 value added. And now for $80 of cloth, the shirt industry is buying this as inputs again and turning into a shirt for $100. So how much value they added? 100 minus 80, you see 20 here. Now notice here we said the raw cotton industry has no inputs. It's just producing an output. And the value that there was $50. The cloth industry, again, there was only one input, which was the raw cotton for $50. And it was turned into a $80 cloth. So that was $30 value added. And for shirt industry, the same logic. We have $80 of inputs and $100 of output, turning into a $20 value added. If you add up these, you see 50 plus 30 plus 20, again, adding up to 100, right? So the final good, which is the shirt, is, if that's the only good representing this overall economy or overall economic activity, that's going to be our GDP. So $100 GDP is equal to the GDP when it's calculated using the value-added approach, right? So 50 plus 30 plus 20 is also equal to 100, which is the same with the expenditure approach, if you will, of $100. Now, what about imports and exports? So far, we only talked about, in a domestic economy, we are producing, we are consuming. And if you were to think, someone in China buying rice from someone in Japan, the expenditures are Chinese because they are buying something from Japan, but who's earning money? Well, a Japanese farmer, a Japanese person is earning money. So how do you think about this in this framework? So how do we account for transactions like this? Since the gross domestic product is defined as domestic product, it counts as Japanese GDP because the rice was produced and sold by a firm in Japan. So exports are included in GDP because they are part of domestic production, but imports are not because they are produced elsewhere. Now, the circular flow model that we just saw considered only households and firms, but the government and the public services, the government provide, they also are, a part of the economy, and they provide some income, and this could be also incorporated in the model. So households receive some goods and services that are supplied by the government, which they do not pay at the point of consumption. A good example would be many countries having primary school education, not necessarily paid in that very moment. The consumption and production of these services can be visualized using circular flow model. So from households to government, households are paying taxes. From government to households, these taxes pay for the production of public services used by households. So we can say that if, for example, citizens are paying on average $15,000 per year tax, so this would be the expenditure because they are spending this in terms of taxes. This $15,000 is turning into the revenue of the government, which then uses it to produce $15,000 worth of goods and public services and goods for the nation. So that's going to be the value added by the government. Well, we will finish with the definition of GDP as expenditure. So gross domestic product is the sum of expenditure by households on consumer goods and services. So this is going to be consumption. We denote with C. By firms and government on aggregate fixed investment in machinery, buildings, and new housing. So this will be denoted by I. By firms on changes in inventories, this will be this double I. The government spending on goods and services, G. Exports, X. So these are, sold to other people in other countries. And the gross domestic product doesn't include the expenditure of households, firms, or government on goods produced abroad. So we need to subtract the imports M. And since consumption, investment, and government expenditure include expenditure by residents on both domestic and foreign produced goods, we need to subtract the import. So the idea pretty much is that when we look at the gross domestic product as an expenditure, what really is happening is that we have consumption, investment, and government expenditure constituting a part of the total expenditure in the economy. But notice, whatever is imported to this economy, it's already in these three accounts, right? So by adding imports, for example, you would have definitely double counted. But also keep in mind, this is not the income received, if you will, in the domestic economy. So we are extracting or taking out the imports for that reason too. So the difference, exports minus imports, we call net exports or trade balance. The trade deficit appears when we have less exports than imports, and we have a trade surplus when we have more exports than imports. So X minus M being positive, surplus, X minus M being negative is a deficit. So the gross domestic product from a different perspective then is going to be equal to consumption plus investment plus inventories plus government expenditure plus net exports.